The price of AI memory chips has more than tripled in the last few months. Not doubled, tripled. And almost nobody outside the chip industry noticed. Everyone's watching Nvidia's stock chart like it's the whole story. But the real thing deciding whether AI companies thrive or completely stall out is happening somewhere else. It's happening in memory factories, in 20-year power contracts, in one single factory most people can't even name. Today, we're ranking the 10 stocks that actually control whether this AI boom keeps climbing or hits a wall it can't get past. The memory squeeze. Let's start with a company you've probably never heard of. Micron. Micron makes the memory chips that feed every AI processor on Earth. Specifically something called HBM, high bandwidth memory. Without it, Nvidia GPU is just an expensive paperweight. Here's the part that should grab your attention. Micron's HBM supply is completely sold out for all of 2026. Customers are signing 5-year contracts just to guarantee they get any. That scarcity pushed Micron stock up roughly 70% this year alone. Its most recent quarter brought in close to $24 billion in revenue. Gross margin hit 75%. That's almost unheard of for a memory company. Historically, memory makers were boom and bust businesses. Prices would crash every few years like clockwork. AI broke that cycle completely. Demand is now structurally tight, not just cyclical anymore. And here's why this matters even if you never buy the stock. When memory gets scarce, every AI server gets more expensive to build. That cost gets passed straight down the entire chain. Watch Micron's earnings closely. It tells you where the whole AI supply chain is actually headed. The one company everyone depends on what most people don't realize is even scarier. Almost every advanced AI chip in the world is built by one single company. Taiwan Semiconductor, TSMC. Nvidia designs chips. AMD designs chips. Apple designs chips. TSMC is the one that actually manufactures them. And right now, TSMC's factories are sold out completely. Revenue is growing more than 30% a year. Profit jumped 58% in a single quarter. Advanced chips, the kind under 7 nanometers, now make up 75% of TSMC's total business. That single number is the AI effect in plain sight. TSMC is spending up to $56 billion expanding its factories just to keep pace with demand. Here's the part most investors completely miss. If TSMC has a problem, every AI company has a problem. Not some of them, all of them at once. That's not a small dependency, that's a single point of failure for the entire industry. Which is exactly why TSMC sits near the top of almost every serious AI stock ranking, even though most beginners skip right past it. Before you skip ahead, here's the part that actually surprised Wall Street analysts. The silicon war. Now let's talk about the chips themselves. Nvidia remains the undisputed leader, no real argument there. Its latest fiscal year posted net income near $117 billion. Earnings per share jumped 60% year over year. Operating income came in above $137 billion. Those numbers sound almost made up for any company. But here's the surprising twist. Investors aren't satisfied with great anymore. Nvidia shares have actually fallen after each of its last 4 earnings reports, even with beats on revenue and profit every single time. The bar is genuinely that high now. Broadcom tells an even sharper version of this story. Its AI revenue soared 43% in a single quarter. The stock still crashed nearly 13% the next day. Why would that happen after a beat that big? Guidance simply wasn't aggressive enough for what Wall Street had already priced in. That's the real lesson for beginners here. Strong earnings alone don't move these stocks anymore. What matters is whether growth accelerates faster than already sky-high expectations. The power problem. Here's what most people don't know at all. AI's biggest constraint right now isn't chips. It's electricity. Training and running today's models needs power at a scale the grid was never built for. That single fact turned boring utility stocks into genuine AI stocks overnight. Vistra is the clearest example of this shift. It signed 20-year power agreements with both Amazon and Meta. Its stock is up roughly 695% since 2021. Constellation Energy owns the largest nuclear fleet in the entire United States. It's locked in long-term power deals with Microsoft and Meta as well. Constellation recently merged with Calpine, adding natural gas and geothermal capacity, specifically to power data centers. Here's the open loop worth sitting with. Every hyperscaler is now competing for the exact same limited electricity supply. Whoever locks in reliable power first effectively wins the next leg of the AI race. That's why energy stocks now matter just as much as chip stocks do. Quick pause before we keep going. If breaking down how these pieces actually connect is useful to you, that's exactly what this channel does. Subscribe now so the next earnings reaction shows up in your feed before the market even reacts. The plumbing. Nobody talks about now. Picture a data center packed wall to wall with GPUs at full power. Those chips generate enormous, almost unmanageable heat. Plain air cooling simply can't keep up anymore. That's exactly where Vertiv comes in. Vertiv builds the liquid cooling and power systems sitting inside AI data centers. Its orders grew 81% over the past year alone. Backlog hit $15 billion, more than double the year before. Then there's Arista Networks, which builds the high-speed networking connecting thousands of GPUs together as one machine. Revenue grew 35% in its latest quarter, and yet the stock still fell 14% right after that report. Sound familiar? It's the exact same pattern we saw with Broadcom. Beat the numbers, miss the sky-high expectations, get punished anyway. These two companies rarely make headlines the way Nvidia does. But without cooling and networking, none of those GPUs ever actually work together. Who's actually paying the bill? So who's funding all of this spending in the first place? The hyperscalers, Microsoft, Amazon, Google, and Meta. Combined, they're projected to spend around $700 billion on AI infrastructure in 2026 alone. That's nearly double what they spent just 1 year earlier. Microsoft alone is budgeting $190 billion in capital spending this year. Its Azure AI business is now running above a $37 billion annual pace. That spending flows directly into the hardware makers underneath it. Dell Technologies is a clear winner in that chain. Its AI-optimized server revenue surged 757% year over year in one recent quarter. Dell's AI order backlog now sits above $43 billion. This is the full circle moment worth remembering. Hyperscalers spend on infrastructure first. Memory, chip, power, and cooling companies get paid before anyone else does. The AI software you actually use every day comes last in that entire chain. To recap, here's your map of the 10. Micron for memory, TSMC for manufacturing, Nvidia and Broadcom for silicon, Vistra and Constellation for power, Vertiv and Arista for the plumbing, holding it together, Microsoft for the demand, and Dell for the hardware that fulfills it. 10 companies, one connected supply chain. Quick disclaimer, none of this is personalized investment advice, and I'm not a financial advisor. This is just a breakdown of what's actually moving these stocks right now. Tomorrow brings a fresh round of earnings reactions across this exact list. Watch the next video to find out which of these 10 just moved the most and why almost nobody saw it coming.